Hi, Larry McDonald here with the Bear Traps Report. We're excited. Jens Nordvig has come to Latin America, to Panama, for the first time. It's been an incredible week. The dollar and rates, historic move. A lot of politics involved with the U.S. midterm elections. Something bigger is happening though, and I consider Jens Nordvig the premier top strategist in the world in currencies. He's got a much broader skill set. He's got also an incredible venture capital arm that he's developed in recent, we can get into that, company in the venture capital space. But we want to kind of give the viewer a little bit of a taste of what we learned this week and the conversation with institutional investors. We have institutional investors and family offices that have joined us here to conference put on by the Bear Traps Report. And Jens, tell me about this week. I mean, I know last week we hosted another private call, and you were really, for the first time, you were bullish on the dollar for the last 4 or 5 months. And I noticed about 10 days ago you turned. What did you see under the surface?
Well, the dollar's had like one of the best years in like 40 years, right? So we've come a very, very long way, but there was some of these indications we're looking around globally where like maybe there's some better news coming out of China, like they're finally giving up their zero COVID policy. Maybe there's something going on in Europe where there's perhaps a little bit more hope for a ceasefire. So nothing super clear, but then the positioning picture, the amount of exposure people had to the dollar really got so extreme that it was starting to get very asymmetric. So we were starting to look for, is there some kind of catalyst for a shift? And obviously today we've had the catalyst, like finally we had like the inflation print resetting just a little bit lower and just enormous move. Like the equity move is enormous, rate move enormous, the dollar move enormous, the gold move enormous, right? So a huge turnaround. I think for the next couple of weeks we're going to see that positions that are built up over a multi-month period are going to be trimmed, right? So this dollar unwinding has more to go.
Let's get into that, because the Exante team, in my mind, I think you created the company 6 years ago, and to me, you have the best positioning data I've ever seen, where mainly your clients are institutions, primarily institutional investors, but the way you track positioning, and it looked to me like last week when you spoke to our clients, it was one of the most crowded dollar trades of all time, both with CTAs, which is more hot money, fast money, and real money accounts, where more like pension funds and the like.
Yeah, that's right. So like we track all these positioning metrics all the time. It gets really interesting when they all show something extreme, right? And you can see that all the real money investors were very overweight dollars. The CTAs were pretty much maxed on dollars, right? So that's the situation where if there's something that goes wrong, it has a disproportionate, non-linear impact. And that's exactly how it's played out. It's not every day that gold moves almost 3%. We've had some G10 currencies move almost 3% today. It's an extremely rare price action. It all comes from the fact that the positioning is offside, so a given catalyst has a disproportionate amount of impact.
Yeah, crowded trades are so dangerous, and at Wall Street the last decade, there's a lot of herding. There's a lot of herding in the street where you have the same people in the same trade, and the trade gets better and better, and currencies go further than equities, right? So you tend to have bigger buildups in positioning because currencies can really go much further than, say, overbought level than an equity trade, I find. But in looking at the dollar versus tertiary currencies, I look at like the Mexican peso, for example. Have you noticed over the last week, I think you were talking about last week, kind of a leading indicator where capital started to flow into the tertiary currencies, Mexican peso, South African rand, and the like?
Two things I would say. Number one, we look very closely at how expectations for growth are developing. And we've generally had downward revisions to growth. Like people are getting more pessimistic about the growth in the US and Europe, but Latin America, actually Mexico, Brazil, and so forth, expectations have started to go in a positive direction. So that was something there in Latin America unusually we found leader. And then I would say also the positioning space in US and Latin that started to see essentially people getting out of long positions before This has happened more than the last couple of days.
Okay. We're going to take a break. We'll be back in a couple minutes. Hi, Larry McDonald with the Bear Trap Support. We're back with Jens Nordvig, and we're looking at currencies, we're looking at risk, we're looking at rates. The rates trade also had a big move this week. How do you look at rates and currencies together? I mean, what are your best macro indicators? I know most of your clients are on the institutional side, but what are the leading indicators you've been using this year?
Well, so clearly the Fed has been key to everything that's been going on, right? It's an unusual cycle. We've not had a cycle where rates got priced to 5% since before the financial crisis, right? So it's many, many years ago.
And that's like the Fed funds rate where people are expecting a 5% Fed funds rate.
Exactly.
And during the last cycle, I think we only got up to 2.5%. Right?
Exactly. So we've already priced double what the last cycle was. So that's the fear that everybody's had. So now we've had finally a CPI print that was a touch lower, and that is getting repriced pretty dramatically. But I think it's not just the level that is important, it's also people's perception of, okay, how wide is the range of possible outcome? And with the CPI now coming down, that is narrowing in.
So big CPI number today, pretty big surprise. As you mentioned, it caught a lot of people off sides. And you're looking at, I think in the presentation you delivered today, we have a conference, Jens is our keynote speaker here in Panama. You put up some really interesting data on that move in CPI and the internals within that, and how do you kind of meticulously measure the internals?
Yeah, so we like to crunch data. We like to build some robots that crunch the data for us. That's kind of what we do. So when the CPI numbers come out, we like to look at everything together. We look at some key medians, right? And really the big shift this month was that goods prices. Goods like so manufactured goods, all that kind of stuff that had been so elevated early in the year finally came down to around 2% on if you annualize it. So that's a big shift. The Fed is going to be very happy about that, I can tell you.
Explain. How does that make Powell's job easier?
We've had inflation way above target now for a multi-month period, right? And at least the goods coming down towards 2% can make them start to think about, okay, can we at least moderate the pace of tightening, right? So we've had 75 basis points now at a number of meetings, and that can go down to 50, 25, we're on a different track. Reducing the risk of some extreme moves is very important.
Yeah, Milton Friedman always said, you don't know, Milton Friedman is one of my favorite economists, but in a hiking cycle, you don't know what you've done for 12 to 18 months after. And by doing 4 consecutive 75 basis point rate hikes, the Fed must be as nervous as a long-tailed cat in a room full of rocking chairs, because that's going to play out, and they don't really understand what they've done. So some people are like, maybe this gives them just an inch open door to a slower policy path going forward, because they're uncertain about how much damage they've created so far.
Yeah, I think that's absolutely right. Like, you can have a model of what you think the terminal rate is, like where rates eventually are going to go. But those models are extremely uncertain, right?
Yeah.
To sit there in a policy meeting and we think, oh, the model says 5 or 4.5, that's not really going to work. So the Fed has to look acutely at the data, but because of the lag you're describing, they're looking at some data that doesn't really have the information that they need. It's a very, very tricky situation for them. But now I think they at least have one key data point that is going to give them an excuse to moderate the pace. Very important for the next couple of meetings.
Now, our research at the Bear Trap Support, we look at systemic risk and risk indicators more so than economic data, because oftentimes it's the risk that actually moves the Fed more than the economic data. In a normal hiking cycle, a calm hiking cycle, the economic data is going to drive decisions. But a lot of the big inflection points the last decade since Lehman have really been driven by risk. And now we have an extra 50 trillion of debt in the system above 2018 levels. How do you look at all that leverage in the system? Because when interest rates go up, bond prices go down, and there's a lot of bonds that are underwater.
Yes, I think one thing, I can mention so many different things about this cycle, this has never happened before. The other thing I would say that is brand new is that we're getting to a degree of inflation pressure that sort of clashes with the amount of debt in the system, right? So central banks, their job is to control inflation, right? But if they're controlling inflation in a way that crashes the economy, can they really just focus only on inflation? That's a tricky balance. Lots of economies around the world have housing markets that are now under severe pressure, right? Can they really hike and focus only on inflation if they see the housing market collapsing? And that's the kind of tricky balancing that they're facing now.
Yeah, in the UK, for example, the percentage of the mortgage market that's tied to I guess flexible rate adjustments or teaser rates that adjust upward when there's higher rates. It's like where the U.S. was in like 2007 when I wrote my book. I wrote a book about the Lehman crisis, a colossal failure of common sense. It's a New York Times bestseller. Pick one up for Christmas, especially for that young business school student. But one of the things we talked about is the U.S. mortgage market was much more susceptible to these teaser rates and rates adjustments. But in the United States over the last decade, we've taken down some of that risk, whereas in Canada and the UK, there's still substantially, actually much more exposure to higher rates than the U.S., for example.
Yeah, no, I think that's right. I think when you look around the world and think about, okay, what places do we have vulnerabilities? I think the debt levels and the exposure to the rate reset as opposed to something long-dated exposure is really important. The UK stands out, Canada, those are key markets, right? The irony is that the markets that used to be very vulnerable in a crisis situation, like emerging markets, in a way are more shielded, right? Because they often have less leverage, less debt in the system, and you can kind of see it already. Places like Mexico, not a lot of debt, one of the best performing currencies the whole year, right? So that is already being reflected in market performance.
That's the fascinating thing about this year, because you have countries like Mexico and Brazil that have been dealing with high interest rates, high inflation for over a decade. And so those economies, like you said, have adjusted. The market participants in those economies that trade stocks and bonds have adjusted. And there's a lot more value stocks, for example, in Brazil than there are in the United States, because the Brazilian economy has been dealing with inflation and high yields for a long time. Yeah. When you go to Brazil, I just delivered a speech there about 2 months ago, and it's like going back. It's like literally you're in the 80s in Brazil, because from 1967, 81, the equity market didn't really go anywhere in the United States because we were in that high, elevated inflation regime. Let's talk about disruptive technologies, because you've shown some just remarkable leadership. You've made a shift in your career somewhat, because you've spent the last decade serving institutional clients. Now you're kind of reaching out to a broader, more retail-focused investors, financial advisors, and trying to protect them from some of this disruptive technologies that you're a part of. Tell us what's happening behind the scenes.
Yeah, so we've built an institutional business that's called Ex-ante Data, right? And now we're building a new business that's called Market Reader.
Market Reader.
Yeah, we want to read the markets very well and understand what's going on with them. So marketreader.com gives you a flavor of what it is we are ultimately going to launch next year.
Marketreader.com.
Yeah, so we want to have a tool that instantly explains why the market is moving. It could be, okay, Amazon stock is moving today. Why? Obviously because of CPI, but it could also be something company specific, could be something with a sector. This tool scans everything from news, social media, all the cross-asset correlation in the market is programmed and can give you an explanation within seconds.
Okay, so retail, family office, financial advisor watching us right now, what are the top 1, 2, 3 things that this new technology does for them? How does it make their life easier, better? How does it make their asset management process more effective?
Yeah, I think it can save them an incredible amount of time, right? Like if you have a portfolio with 20 assets in it, just keeping track of what's actually moving them can be very hard. So if you can save like an hour or two every day just understanding why your portfolio is moving, then you have extra time to actually make good decisions about what to do with your portfolio. So that's one thing.
So it's time, like in the old days when I was coming up in the 80s and 90s, a piece of news would hit, and you'd really have to look in barons on the weekend, and the market would figure it out over 2, 3, 4 days. And now there's a good compression period. So what you're saying is this technology could save the retail investor a lot of time in being able to quantify what's going on.
I think that's one aspect. The other aspect is that if you're trying to figure out what's going on with your portfolio, go to traditional news sources, you might have journalists that try to make up an explanation, right?
Yeah.
We have hardcore algorithms that really use data-driven approach, like very sophisticated statistics to come up with their underlying truth. So the conviction level we have in having found the real reason, I think, is so much higher.
That is such a great point because, over the last decade, being a New York Times bestselling author and being a part of the financial community in terms of media, you definitely see a lot of news services want to create clicks, right? And they will guess, and they will be provocative, and they will guess, and some of the headlines don't necessarily get into the truth of behind the situation because they want to draw the eyeballs on the news story. And they're not really risk takers, they're not really market participants, they're young journalists that are kind of, guessing in the wind. And so this technology really kind of burns through some of that noise.
The robot is going to be objective.
The robot's going to be objective.
It's also going to work hard, right? Because we're watching literally all assets in the U.S. market in real time. Currently around 11,000 assets, right? So the robot is going to work hard. If there's anything going on with these assets, it's going to tell you, right? So it just has more capacity. So more objective and more quantity can just do more. And
so someone watching us right now, one of the things that I've been impressed with your career is you don't just look at equities, you have, I think, one of the best cross-asset lenses in the business. And what I mean by that is the connection between a stock and a sector, or that sector and rates, bonds and FX.
This is so important, right? If you're trying to explain stock moves with only information that is specific to that stock, maybe you can explain 10%. 90% comes actually from the association to the other assets, right?
Yes.
So we've modeled all that out. So we can say, okay, Exxon is moving because oil is moving because there's this thing going on that's related to oil. All these linkages are going to be keys to getting the full picture. If you only do company-specific stuff, you're going to be missing most of the picture.
You're only seeing about 10% of the picture.
Yeah.
And I think this technology, I'm so excited about it because in the 90s, one of my best friends, Steve Seafeld, and I, we created ConvertBond.com, and it was a disruptive technology. We took the entire convertible universe, we had it on the web, and thank God in October of '99 we sold it to Morgan Stanley. But ever since that moment, I've really been looking at kind of like, okay, where is technology going to be in 5 years, 10 years? I think that the landscape has been terribly uneven. In other words, the institutions, the quants, they've got this great technology, whereas the investor at home watching us right now, doesn't necessarily have those tools. I look at this, I look at your thinking and this evolution as kind of more of an equalizer between quantitative.
No, I think that's what I think is really fun about this. So I love watching what's going on in the global economy, what's going on in markets, right? At the moment, I have a business where we serve like literally the most sophisticated investors in the world, but there are not thousands of them. There are a couple of hundred of really top-end asset managers that can digest like enormous amount of data. We want to create a tool that can be used by millions of people, whether it's somebody managing a 401k in the US or a small individual somewhere else. They all can benefit from a tool that objectively describes what's going on and puts that information in an easily accessible way right in front of them. So not a couple of hundred people, it should be millions of people using market reader technology.
I love it. Well, thanks for the leadership there. And just in macro and closing, let's think of the last 5 weeks. We had a midterm election. Equities mysteriously rallied into that midterm election. We had financial conditions which were very tight 5-6 weeks ago. Financial conditions have eased. The dollar has rolled over. There were a number of things that happened over the last month to create this segment. Number one, like you said, China, just a hint of a softer path in terms of reopening, or a better path. Europe hit by, obviously, natural gas prices have come down in Europe. Okay, that's probably gives you a little bit better scenario there. But I thought like 3 Fridays ago that the market was under tremendous stress. You had 2 Fed governors come out and kind of soften the path a little bit in terms of laying out a potentially soft path. In other words, the Fed potentially not taking a break, but just not hiking as aggressively. And the same day, you had the Bank of Japan coming in and defending the yen. And I mean, when you lived through that during 4 or 5 weeks ago, how relative to today, how are you looking at the market then versus now, and do you see that connectivity? What type of connectivity is there in it?
I think when you have these big trends in the market and big turning points, it's very rare that you just have one thing that turns. Like it's always like a confluence of factors, right?
Yeah.
And you mentioned the China thing, slightly better news on the energy crisis in Europe, right? And then hints that the Fed kind of wanted to slow down. The goal was to slow down. That means that the market's now become hypersensitive to any data that allows them to actually slow down, right? And that's exactly where we've ended up. So, pretty important turning point after a mega run in the dollar. One of the biggest runs in the dollar ever, right? So, markets are not linear. Markets never continue in one way forever, right? So we came very far, and now we've reached some kind of inflection point in the dollar.
Well, you gave a great speech today. We thank you for coming to our event. I think we got to get you more on the road. You got to speak to more institutional investors and retail investors.
You picked a great venue here. Thanks for organizing it.
Thanks for coming.
Thank you.
Appreciate it.